Hey guys, this is a market update. Some great analysis in this video of where the market is right now and what's going to be happening to Bitcoin over the next 6 months or so. Plus, if you're a long-term investor, watch till the end because there's a great article here about the long-term bull case for Bitcoin, and it shows you what's going to be happening potentially over the next 10 years or so, where I think Bitcoin is best positioned as an asset. So getting to the short term initially, I'm seeing a divergence here between relative strength and also the price of Bitcoin. We've been trending down, and the volatility of Bitcoin has been essentially nothing over the past, 6 weeks or so, really consolidating around this level around 18, 19,000. We're actually trying to break out of this, what some people may see as a descending wedge right here. It could be a descending wedge. You see the price trend down, and you also see this support level right here, which has been very, very strong support over 6 months or so now. So we're seeing a divergence here, I am anyway, in terms of the price coming down and reaching new lows right here on the highs, and then this divergence of the RSI, which is actually going up. So it's telling me that there is relative strength around this price. And so what we're actually seeing right now is a little jump in the price of Bitcoin, trying to potentially break through this downtrend in prices. Now, this is going to be dependent on what the market does as well. The market is rallying here as well, and there are a few reasons for that, which I'm going to go through in this video, but we could potentially see a breakout of this. And then that, in my opinion, is kind of a new regime, a new trading regime for Bitcoin over the short term. But there's still many economic figures that we need, essentially CPI and inflation coming down. But we can see that is coming down. Before we move on to that, if you want to get a deposit bonus on Bybit, if you want to trade crypto, they give a deposit bonus in your futures trading account up to $4,000. Link in description for that. They're also giving free spot trades right now as well across the entire platform. So it's a pretty good short-term bonus. But as we can see here, I want to get onto inflation, CPI, and growth, because Bitcoin is essentially a inverse bond. Okay, so rates going up, money supply coming out of the system, credit growth slowing. That's not good for Bitcoin. And as rates normalize, even come down, that's good for Bitcoin, right? So an inverse bond. As you can see here, what Goldman Sachs is saying is that the chart below shows the year-over-year change in the Goldman Sachs FCI index lagged 6 months. It's tracked PMIs closely and is currently implying PMIs could go down to the low 40s. Now, what that means is, well, anything above 50 is economic growth. Anything below 50 is economic recession. Low 40s is major recession, and governments will not allow that for a long period of time, and I'll get onto why later on in the video. Although the equity market is already beginning to anticipate a slowdown, there could be another leg lower to this trade as cyclicals, defensives, ex-commodities are currently indicating a more moderate growth slowdown. So it's important to understand that this projection right here doesn't take into account any potential intervention by governments in terms of spending or other incentives to encourage growth. And so that's what this is anticipating right here. Now, obviously, at some point when PMIs get low enough, that's when governments or even central banks start stepping in and saying, we need to support growth here. So the inflation picture is changing now. I've been saying this for a long time. I think the inflation picture is moving into, hey, look, growth is really slowing and governments will need to do something about it. Now, the timing of this is all uncertain, and so we don't know what central banks and governments do or their plans or how they react to certain things in the market. But as we can see, we are stepping into, the further along we go, we are stepping into lower growth territory. Now, do you really want to take the advice of everyone on CNBC saying you must go into cyclicals and defensives during this period because they'll perform the best? Well, it doesn't look like they're going to perform the best over the next 6 months. We've already seen that tech and the NASDAQ potentially has bottomed in some areas as well. It won't come all at once, but you have to read the signs here if you want to predict maybe 6-12 months out in the future. We're getting bond experts now on CNBC saying now is the time to get into bonds because inflation is peaking. Now, do I agree with them? For the most part, yes. The rate of inflation coming down, that is all uncertain, but you're seeing more and more people come out now saying maybe inflation is peaking, maybe it's time to buy bonds because these rates are quite attractive and may not last forever in terms of the bond maybe, staying where it is, not getting much higher. Do I want to invest in fixed income? Absolutely not, and I'll tell you the reasons for that later on in the video. More on the inflation rate as well and CPI, you're seeing rent start to come down. This is one of the biggest factors of CPI. As you can see here, Zillow monthly data recently updated through the end of September, rental market is normalizing. You can see rents starting to come down here. This is one of the biggest, if not, the biggest factor of CPI inflation. And, generally people in that cohort that are renting, free cash flow is obviously very important. The less you pay on rent, the more you have for the economy, and that may prevent any severe recession. So very important for that. You can see that Redfin as well just reported the median US rent registered the first monthly decline in a long while, as you can see here. So these are the first steps of potentially that coming down. That will take a very long time to come into CPI. But of course, you can read through if demand is getting crushed and rents are coming down, large part of CPI, maybe that picture of on inflation is actually starting to change right now. And you're seeing people starting to come out saying that as well. So why are bond experts now coming on TV and saying, bonds won't go much higher? Well, because of this is the US 2-year. As you can see, this blue line right here is what the Federal Reserve themselves say is the peak for their federal funds rate, the official interest rate, at around 4.5, 4.6%. Well, the US 2-year is now around 4.45, 4.44. So if the market just goes up to this official rate, that's it. There is no more tightening from interest rates to occur, at least in this part of the yield curve. You can see the real kind of bad spot for Bitcoin was when rates on the 2-year went from 0 up to this level, a 4,500% increase. Well, that's not happening anymore. And so the regime that we're in is different. Now, there are many ways that this can go higher. For example, if there are many illiquid, high-yielding bonds that are potentially completely illiquid in the market and no one can trade out of them, that is systemic risk, that's credit risk, and that's a big issue right now. And that's why you see Janet Yellen coming out and saying, we're worried about certain parts of the ETF market. These are bond funds that are completely illiquid. And so you have a lot of insurance funds, pension funds invested in those, that the bond is selling off and they have absolutely no liquidity to sell out. Now, if Janet Yellen is saying they're looking at this, then what that also means is that they're potentially going to step in if anything happens, just like the Bank of England did. So you're seeing central banks speak out of both sides of their mouth, raising interest rates, but also printing endless money to make sure these markets don't seize up. So, in terms of the absolute rate, if we're seeing inflation come down now, this may be the peak in rates. It may be, but there are of course many data points still to come out to potentially force us higher if inflation doesn't come down. Now on to some longer term info for Bitcoin. We had Michael Berry, who is the trader for the long short, that correctly anticipated the complete destruction of the mortgage-backed securities market back in 2008. Just reposted this. He very, very rarely tweets. So this is an article with really a long-term outlook of what's happening to the economy and rates. So very important in terms of Bitcoin as well. So back in 2008, the world economy came to the brink of a deflationary debt liquidation where the entire system was at risk of crashing down. We've known that for years. So these days, we can't stand normal, necessary recessions anymore without fearing a collapse of the system. We're talking about the treasury markets collapsing and seizing up, which you just saw small parts of in the UK. And obviously, the US is very worried about this as well. So the level of debt, both private and public, has to come down. So what's triggered this process? This person's structural argument is that the power to control the creation of money has moved from central banks to governments. By issuing state guarantees on bank credit during the COVID crisis, governments have effectively taken over the levers of control and the creation of money. Just to give some stats here, on bank loans to corporates within the European Union since February 2020, out of all new bank loans in Germany, 40% are guaranteed by the government. That means that even if they go bad, the loans, taxpayers are essentially paying for that. By building the growth of credit and therefore the growth of money, they can control the nominal growth of the economy. It's very important to understand that governments will not let bad recessions happen, big recessions happen. They need that growth. They need to essentially take wealth away from people, not from a hard recession, but through the debasement of currency, which leads into my thesis of Bitcoin. Engineering a higher nominal GDP growth through a higher structural level of inflation is a proven way to get rid of high levels of debt. That's exactly how they did it after World War II. I think we'll see a consumer price inflation settling into a range between 4 and 6%, so not the 2% that is currently the target. Without the energy shock, we might have been there already, certainly in the States, potentially. We today have a disconnect between hawkish rhetorics of central banks and actions of the government, which are just printing money to purchase energy at a higher price. Also, some comment here about bond yields and why bond yields can't be very high for very long. Certainly to the ECB, and definitely the Bank of England and the Bank of Japan, these countries are already well on their path to financial repression. It will happen in the US too, but we have a lag there. I'm much more positive on the US personally because it is constantly an area of innovation and small businesses doing very well for their economy. But investment money flows from Europe and Japan towards America. But there will come a point where it will be too much for the US as well. Watch the level of bond yields. There is a level of bond yields that is just unacceptable for the US. We're possibly getting there right now because it would hurt the economy too much. My argument for the past 2 years was that Europe can't let rates go up, not even from current levels. So that's an argument as to why the central banks have to raise so aggressively these days, is because they actually have to get the rate hikes in to a high enough level before that actually starts affecting the economy. Because if they did it slowly enough, then the GDP would fall before they've got to a level where they can cut again. So a lot of this plays in, and I just want to forward over to this part as well. Are we in the start of this process? Absolutely. I think we'll need at least 15 years of government-directed investment and financial repression. Average total debt to GDP is at 300% today. You need that down to around 200% or less. So what's the end game? Well, first comes the seemingly benign part after this potential rate hiking cycle, which is driven by a boom in capital investment and high growth in nominal GDP. Many people will like that. Only much later, when we get high inflation, this is down the line after this inflation cycle is over and the next boom, we see high unemployment when the scale of misallocated capital manifests itself in high misery index. So what does this mean for investors? First of all, avoid all government bonds. Government bonds, even with these high yields right now, are going to start coming down again as governments and central banks need to run inflation hotter than actual growth. Investors in government debt are the ones who will be robbed slowly. This is why everyone is moving to Bitcoin, or at least some people are saying Bitcoin is the hedge against debasement of debt and currency. Within equities, there are sectors that will do very well. The great problems we have, energy, climate change, defense, moving production out of China, will all be solved by massive investment. This capex boom could last for a long time. Companies that are geared towards this renaissance of capital spending will do well. Gold will do well. So obviously replace that with Bitcoin for me personally. But hey, if you want to invest in gold, that's up to you. The inflation won't come down to pre-2020 levels, but will settle between 4 and 6%. That's just one opinion. I will leave that article linked in the description because there's a lot more to it and a lot more nuance as well. How does this affect Bitcoin? Well, if you think gold's going to do well, Bitcoin is far superior in terms of its use as money, and it has the potential upside of that growth in the network as well from a much smaller base than gold. Of course, I'm a Bitcoin bull, so take what I say with a pinch of salt as well. If you want to get that deposit bonus on Bybit, or if you want to trade in the spot market without any fees, link in description. I'm James with Money's EG. Cheers for watching, and I'll see you in the next one.